Okay, everybody, welcome to the UBS and TFEM AI and Data Analytics Seminar. I'm really happy to have Irene Aldridge with us today. Irene has written 3 books on...
Six.
Are we counting second editions of books, or are we...
Well, I have a bunch of other books that kind of went straight to DVD, but...
Well, she's a prolific writer, and in fact, in one of her first books, had sort of discovered one of my papers, and that's really how we became friends and colleagues. And she has 2 companies, AbleMarkets and AbleBlox, which I think the work she'll talk about today will be related to her cryptocurrency company and her work in that area. And yeah, Irene, last but not least, is a faculty at Cornell Financial Engineering Manhattan. So some of you who are about to start studying at CFEM will get to know her. And she's an all-around great speaker. So I'm really happy to have her speak at the seminar today. Thanks, Irene.
Thank you so much, Sasha, and thank you so much, Rizal. It's a real pleasure to be here. I must say, I love Cornell. I think it's awesome. It just really is, both in Ithaca and in New York City. I think it just has this amazing feeling, and of course, amazing faculty, and everybody's super nice and super intelligent, and so it's really cool, and Sasha is very cool, so and Roselle, and so, and I can go on and on about this, but it's my real pleasure to be here today. So I really appreciate this invitation to speak, and I'm going to speak about crypto and automated market making design. As Sasha mentioned, one of our intersecting interests is really microstructure. And microstructure refers to basically how markets operate, how negotiation systems operate in the markets, something that we often take for granted, especially if we're portfolio managers and we take long-term positions. So today what I'm going to talk about is the new kind of market structure that's originated in crypto. But as I'll show you by the end, I hope to convince you that it's actually actively being deployed in traditional markets today. So we have to take it into account in whatever you're doing, whether you're just trading or you're doing execution of orders or anything along those lines. Okay, so and of course there are all these issues in crypto that everybody's concerned about, like the thefts, and so I'm going to address these items too, about how they filter into the whole system. Okay, so this is just a brief outline. I do have a lot of slides, so I will go pretty fast. I apologize. Please feel free to answer questions. Sasha is in charge of well, he volunteered, rather, not in charge. He volunteered to moderate. So thank you very much. But again, I apologize if this is too fast, and please feel free to reach out to me after the presentation. My email is at the bottom of the page. It's just irene@ablemarkets.com. Thank you. So this is what I plan to go through. I plan to go through basically blockchain 101. And it's really for people who really, you know, just introduction, and it's pretty new, so there can be some positive reinforcement. Then we look through blockchain applications in finance. We look through how it is programmed, and then we'll dive into this automated market making, which is the new microstructure, and we'll look at different curves, and then just look at case studies of market making in practice, and the spillovers to traditional markets. Okay, so this is just a very brief background. I'm an electrical engineer by training. I went to Cooper Union downtown, and then I studied PhD in operations research, and I later switched to finance. The operations research was at Columbia, and then I worked through basically the entire industry. I started as in trading globalization. I moved into risk management. I worked in research, equity research, and ETF research, and then I ended up on the trading floor where we started developing high frequency trading strategies. And we got seated, and I ran a shop called Able Alpha for a while. It was a prop trading, high frequency trading shop. And then one of our clients approached us to buy data. So that's how we got into AbleMarkets, which was really the data analytics company. And most recently, we formed AbleBlox, which is a blockchain-based things that we're developing, and I've been very privileged, and I'm always greatly appreciative to teach at Cornell. It's a real treat with super smart students and of course amazing faculty to collaborate with, and I've had great pleasure of writing several books. One of them is with great and late, unfortunately, Marco Avellaneda, which you see the picture there. Right. So, today, where I'm going to talk about, again, blockchain. So basically, blockchain, a lot of people think of it as blocks, and I think it's a fair thing. I come from a traditional kind of old style computer science background. What I like to think about is a fancy database. All right. So it's a fancy database where each row carries over a piece from the previous row. Not just a piece from a previous row, but it carries over a cryptographic summary of the previous row. Okay, so one row, you put in the data and you commit it. The next row, you take the cryptographic signature, or you take the cryptographic summary of the previous row, and you attach it as a separate field in your next row. And you keep growing this database like this, row by row, and every row is dependent on the previous row. So the basic idea here is that if somebody goes in and decides to modify row 3, okay, then what they will have to do is they will have to go in and change sequentially every single row, because the signature of that row 3, like the content of that row 3, is going to affect every single signature of each row subsequent to that row 3. Okay, so and the bigger your chain is, the more difficult, computationally difficult it is to do. Okay, so that's in the very, very basic kind of overview what really blockchain is what I see. Okay, so now to complete each block, in addition, we need some validation, and I'm going to talk about this in detail. So, but when we talk about mining the blockchain, what we're really talking about is somebody who is going to examine the proposed content of the block, and that's in optimal theory, and then say, okay, it's okay, and they're going to commit it to memory. All right, so there's some other stuff they have to do that I'm going to address shortly too. They have to basically solve a riddle because the signature has to be of a specific shape, but it depends again on your blockchain configuration. So in our AbleBlox, you can look it up at AbleBlox.com. This is a sample blockchain that we have running continuously, and you can just play with it. You can mine it. There's no particular purpose to it. It's just the content of this blockchain is just all the visitors' IPs that have visited this particular blockchain. So there's no other purpose to it than just to illustrate the point, right? But it's a pretty straightforward kind of thing. So, and of course, it's very valuable because it helps us in essence to move all our paperwork to blockchain, and maybe we can move payments to blockchain, like letters of credit, and there are a bunch of startups that are already running on blockchain, and we can also use it to broadcast all the transactions. One of the things about blockchain, it's transparent. So the fact that it's decentralized, what it means is a bunch of people have a copy of the entire database, right? So all the rows, they're not just secretly stored in some Oracle server, right? Everybody has a copy. So that ensures that, if somebody fails, if one server fails, there's a lot of other servers around. But of course, it also creates issues of who can see what. All right. So this whole blockchain idea goes to the original paper of Nakamoto, which is 2008, which nobody really knows who this Nakamoto was, but it's surprisingly readable paper. It's like really easy to read, and it's really easy to understand, extremely well written. So, and what he said, we're just going to, or maybe it's a she, who knows? So, but what this person said is, we're just going to get rid of the traditional model where we have a third party like Oracle server that collects all the data. And instead, we're just going to make all the transactions public. All right. So now we don't have this privacy anymore, but we do have robustness as a result of many people having a copy of the database on their servers. And of course, there's a lot of issues that people need to address in this situation. So we have decentralized consensus, but then when a lot of people decide whether something is a good transaction or not, right? But then everybody's sacrificing collectively their privacy, and everything becomes transparent. Now, it's I think the privacy loss has been very hard for people to swallow until a few years ago, when we all of a sudden realized that we already live in this glass box with Facebook and cameras everywhere. So I don't think people are as concerned about privacy anymore as they used to be like 10 or 15 years ago. So that's kind of going away. But also, to program this blockchain, right, it's pretty straightforward. So what we need to do is we need to define a block, which is basically a database row, right? And we have to decide what fields we're going to have there, what we're going to store in that. And then we have to create this crypto signature, which is hash. And there are lots of hash functions already available, Python off the shelf, or if you're using the Solidity or any other language, C++, there's lots of that has already been done in computer science years ago. So there's nothing really new here, because you're just going to take this function and you're going to encode the previous block and import the signature into the next block. And then you have to create a blockchain. So that's something different, because you need to initialize the blockchain. You have to add the first block, and then you have to keep track of the reference to the last block. And in computer science, this is known as linked list, right? So that's what we're doing, and this is decentralized. Now, the two core innovations here are these the proof of work system and a mining procedure, and that's what I'm going to talk about now. So proof of work is kind of interesting. So to commit the block to the memory, you have to prove that you've actually, done something useful and you really want to commit it, right? So it's not costless. Okay, so, and I'm going to talk about other iterations where you can do it differently, but generally, like people who are committing the blocks to the memory to do some work. All right, and this goes from Satoshi Nakamoto's original idea. Okay, and so and the reason for that is there are security implications that I'm going to discuss too. But so to do work, what Satoshi Nakamoto wanted everybody to do is to solve a riddle. All right. So what he said is, we don't want just to take a cryptographic signature of the content and just slap it back into the database. We want to make sure that our cryptographic signature starts with number 0. All right. So and then the number of zeros keeps growing as the blockchain keeps growing. So in many cases, you have to rehash and rehash and rehash and develop new hashes until you finally find this number of zeros in front of the signature to make it more complicated. And the reason why he wanted to make it so complicated is because the idea was that if somebody wants to hack the system and they want to get in and basically change the entire chain, okay, so they're just hacking in row 3. And then they're recalculating the entire chain, because it's so computationally complex to recalculate the entire chain. Their kind of division of the chain, or their part of the chain, is always will never catch up with the rest of the chain. Okay, because the computational complexity there ensures that the true chain that has not been modified keeps moving ahead. Right. So that was all great, and that worked very, very well for many, many years. People made a lot of money on mining because it was pretty easy and straightforward, and it wasn't a big deal until basically recently, when it became like too complex. So it's becoming so complex and so expensive for people to mine these chains, because you have to spend electricity, on just computer power, and then you have to spend electricity on air conditioning to make sure your computers don't overheat, the basic things like that, but they all add up to this mining process, and it's just becoming too much. Okay, so we're approaching, I've seen a few papers that talk about equilibrium, where there is now a natural kind of group of people developing who figured out how to make this mining cost effective, and they're the ones who are mining, and the rest of people are not mining because it's just too bloody expensive to do that. So there are these dynamics going on where we're kind of seeing this issue. So, but the great thing, it's the original idea did survive for many years, and it was very stable, and well, except for when everything was hashed, but that's a separate topic. So this proof of work, right? So if there's no collusion, then the honest chain grows the fastest. So this is the one that has not been hacked, right? So, and bad guys basically naturally fall behind when they're recomputing the chain, because they have to solve these ever increasingly complex riddles. So when this not Satoshi Nakamoto's principle, well, these nodes, these chains, they rejoin the system. People can turn off their computers and then just go back into the system, but that's the strength of the decentralized model. So the core engine automatically selects the longest chain, and that longest chain is going to be the honest chain in theory, because it's been the one that has been, the other chains cannot catch up with it because they have to recalculate all those riddles, right? So that's kind of the basic principle. And these zeros, by the way, the leading zeros are known as nonces. Okay, so there's a bit of other terminology. So of course, over the years, as the number of miners is decreasing, there is a growing problem that if a miner goes, one miner goes to sleep, the other miner can catch up and actually introduce some hack stuff into the system. All right. So another thing about proof of work, traditionally with Satoshi Nakamoto's principle, only one CPU could validate, could vote on the validity of transaction, or can do the validation. So that's basically too much work. And of course, you can have a machine with 8 CPUs, etc. So these are some of the issues that kind of raise kind of questions about Satoshi Nakamoto's principle. And again, they become we're approaching equilibrium. That's something that I mentioned. There's really too much time it takes to mine, and the compensation for mining is just not there. So there are other solutions that are coming online. And of course, if you have a natural incentive to mine, like for example, if you gain something from seeing this information before you commit it to the server, then it becomes more advantageous. You become a more interested miner to do this, even if you're losing money. And this is kind of issues that we're facing now, is that there's a lot of front running potentially going on, where, and I think Agostino Caponi has a lot of research on this, where you can actually, the people who do mining now, they're the same people who trade, right? So they see all the trades before they're actually committed into the server, and they can insert their own trades into the blocks. And there are a lot of conflict of issues, of interest problems that arise from that. So one of the things that Ethereum started doing, they now aggregate these blocks every 12 seconds. They're committing the blocks every 12 seconds, regardless of whether there's what kind of activity goes on. So anyway, so these are just some solutions that go on. Now, to mine the system is to program it is very simple. You add new block, you check if this proof of work is valid, you add new transactions, and you commit it to the chain. Okay. So another thing that people have started doing, like Coinbase, they're not asking people to necessarily solve these riddles anymore. So what they're trying to do is, or what they have been doing, is staking. So what the staking does is basically you can mine if you put money into the system, right? So you put your stake with, or collateral rather in traditional lingo, into the process, and then you have access to looking at all of these transactions, and you can lock up. You can have a lockup period for that stake, and if you, on your watch, when you're committing these transactions, there is fraud, then you pay for it with your stake. All right. So of course, again, this creates a group, or kind of an oligopoly of all these crypto oligarchs now that mine, and they're really the elite groups because they put the most stake there, and they see everybody's transactions, and again, they can manipulate the market. So there are all these problems. Another solution that people have been using is off-chain, this off-chain validation. And off-chain is basically our traditional internalization that's known in equities and in futures. So you really have your own blockchain running, you match all the orders internally, and then you commit your block to the chain, and that saves the electricity, which we call gas fees in crypto, and everything along those lines. So the reason I'm going over these things is because I'm getting to the important very important topic of automated market making, and just understanding all this background information helps us see why automated market making is important, and what kind of manipulation people can do in that space. All right. So now we're going to automated market making. So there are many crypto tokens. They're basically individual currencies. They're platforms that issue tokens, and you know, there's some platforms that encourage you to issue tokens. So it's not that it's a new idea, and it's if you think about reward systems, like there's a store called Canadian Tire in Canada, and they've been issuing Canadian Tire money for forever, right? So we're talking about this Canadian Tire money, play money, that's now online, and people can do all sorts of stuff with it. All right, so it's kind of like store credit, or maybe a loyalty program, you can think about it. But of course, some people make it a much more serious thing. Their value of tokens, it can basically comes from the utility in our standard economic models. And the utility may be you can conduct business on the platform, or you can invest into the tokens long term. And these guys are called hodlers, right? They're also a term OG, which is original gangster, people who originally invested into crypto and became hodlers. But hodlers are the guys who hold on for dear life. It's sort of like our old idea of marrying a stock, right? Not that different. But and then we have guys who do liquidity provision or automated market making. That's the subject really of this talk today. So these are the three players, if you will, in our ecosystem. They're basically very similar players that we have in any of the markets. So we have market makers, right? We have investors, and then we have essentially a retail class of guys who are just there because, you know, they're doing something. Okay, so but this is automated market making versus limit order book, and this is interesting because the limit order book is obviously traditional, and for many years was considered the dominant structure, that's unbreakable dominant structure. In fact, in 2005, Singapore Stock Exchange introduced some other auction-based structure, and they scrapped it in favor of centralized limit order book. And everybody says, see, you know, centralized limit order book is the stuff. But if you look at the adoption of automated market making versus centralized limit order book in crypto, then it's automated market making is definitely taken off, and it looks like it's here to stay. It's very popular. Now, there are different products and different kind of automated market making systems that people have developed. Most of them are open source, so you can actually go and see how they have been built, and there is some sort of a document that explains with description about their thinking and everything along those lines. And there are a lot of different platforms, and they've started these development. It was all started by computer scientists without any real background in economics. So in that sense, it's very different. I don't have time today to get in, let's say, in logarithmic market scoring rules, but it's something that's is very well thought through. Now, there are different functions. For all of these platforms, they have different what's called AMM curves. Okay, and all of these curves are very similar, but they're different in their curvature, different in their offsets. This is just an example of what kind of curves they are for different automated market making. So these curves can also shift when you have different liquidity. Okay, so the more liquidity you have, the closer or less liquidity, the closer your curve is to the axis, and the more liquidity you have, the farther away you are. But the fundamental principle is the same. So you have this curve. You have a certain liquidity kind of backing it up, and the price is really the function of the remaining inventory in the liquidity pool. Okay. So as a trader, the more you buy, the less the liquidity pool has, and therefore the higher the price. And this curve works nicely in that respect because it's asymptotically it's exponentially increasing as the less inventory there is left of a specific asset, right? So for any two assets, the less stuff you have, the higher is your price. So that's where the automated thing comes in very handy, because you can go to sleep and you can trade 24, or this thing can trade 24 hours. And if there is a run on your market, your price will automatically go to infinity in principle, right? So that helps a lot. This is something that's not present in the centralized limit order book, where it's, you just set your limit orders there, and you can just, if you go to sleep, you may get run over and taking advantage of, because somebody else has better information, asymmetric information that you do not have. And the price is really determined as a tangent of this curve. So the slope of the curve really determines how the price is computed. And essentially, the less inventory, well, as I mentioned, less inventory there is, the higher the price. So, but you basically move from one point to another point on the curve, depending on the inventory and the liquidity pool. Okay, so and this is a separate topic. But I'm happy to talk about this after after the thing. So most models, they have an invariant. So an invariant is kind of a constant that related to the liquidity that shapes that curve. All right, so it determines the shape of the curve. Like, for example, in this logarithmic market scoring rule, the invariant is related to the two quantities in the following way. Okay, so there is a quantity 1 that's outstanding in the liquidity pool of asset 1. Quantity 2, there's some constant L, and the invariant is that thing that keeps it all together. But then during the volatility, this all works very nicely. It can take care of it 24/7. But they can lose money. AMMs can lose money in these volatile conditions as well. So what AMMs are doing is they're putting in transaction fees, right? So the transaction fees are often the flat fees for the liquidity provision. That's something that people use. And generally, if you compare AMMs with LOBs, centralized limit order books, then AMMs do not have a spread. Okay, so there's no bid-ask spread. They just quote you the price, versus traditional limit order books do have a spread. AMMs do have a transaction cost, which traditional markets do not. Quotes do not vary with uncertainty. So you have a very certain curve, which ties together all the prices, which of course they do not, does not exist in the quotes do not do vary in uncertainty in traditional markets. Quotes vary with liquidity in both markets, but quotes do not vary with inventory in traditional markets, but they do in AMMs. et cetera, et cetera. So there's of course instantaneous settlement, which is great for many. There are multiple liquidity providers only in the traditional markets, right? So in the AMM markets, you have a liquidity pool that takes care of everything. And prices do move along a pre-specified path in AMMs, but not in traditional markets. So you have, as a result, you have continuous liquidity. You have 24/7 markets, which is a huge thing. You have formulaic slippage, which is also can be very good, because if you are concerned about slippage, you can estimate it ahead of time based on the curve. And then you have a interesting part, which is fair value. So in traditional limit order books, you have mark to market and fair value. Here in automated market making, and this is really I think a matter of a misnomer a bit, but fair value is called the impermanent loss. So the idea is that if you bought something at the historical value, then if the value has declined, it's impermanent. It's impermanent until you withdraw the money at the market price, which is, it's kind of it's not exactly reflecting the reality. It should be market value. But anyway, so here's an example of constant product market making, which is deployed at Uniswap, which is a very popular system. And so it's a very simple idea. You have quantity of one instrument times quantity of the other instrument equals to an invariant. All right. So we have an invariant, whatever it is, and it's just a product. And this happens to trace a convex curve rather between Q1 and Q2. So, and all the curves in AMM should be convex. I hope you can see that, because as the quantity declines of a specific asset in your liquidity pool, you want the price to increase, right? So that you don't get run over. And that's a fundamental part here. So all of the curves that we've seen previously here, they're all convex. Okay, so there's some with a slight concavity, but generally they're either straight lines or they're convex. Okay, so they all have the same shape. They're all in the first quadrant. They all span x-axis and y-axis, if you will. So, and it's just a better model that's traditionally aligned with traditional like supply and demand model, right? So, and on the left, you see a different curve, which is price versus quantity, which is also the traditional supply model, right? So we have available supply as quantity increases. Well, actually, no, that's not the case. But the quantity to quantity has to be convex. On top of, we have on y-axis we have price over quantity. Okay, so it's price over quantity. So that is it. That is correct curve. Okay, so bottom line is, now that we know that all these curves are always kind of the same shape, we can approximately fit the curves based on the available data. And there's a lot of crypto data out there, right? So people just publish data because they want to attract traders. So they want to create, allow people to build historical models. So there's a lot of data. And again, all these models are structurally similar. So let's say we assume that we, just for basic hour exercise, we just assume this constant product market making because it's super simple. And this is what it produces on the right. Okay. This is constant sum market making. It's going to produce a straight line. It's not that drastically different. Like for the purposes of what I'm going to show you, we're going to assume that this is enough. All right. But basically what we're going to do is we're going to take data from different exchanges and parameterize it. Okay. So we're going to assume this constant product market making and see where we stand in terms of liquidity and compare platforms. And with that, we can determine as an execution broker whether we should wait or we should execute, or which platform we should choose, stuff like that. All right. So what kind of data do we have? We have standard data. We have open, high, low, close. Often we have volume. Some exchanges even add number of trades or volume in the other currency. So this is all kind of available. All right. So very, very standard. And how we're going to parameterize that? Well, we know that there is some invariant that has to be involved. So this invariant is C, it's a constant. Okay, we have two quantities, quantity of one first instrument and quantity of the second instrument. And we have from one trade to the next, we know that there's going to be some shift in quantity, right? So if somebody buys Q1, then there's going to be some delta Q1 that's going to affect bring us to the next step, right? So so if for a given change in volume in currency one in our liquidity pool, which is the trade volume, really, right? Red delta is the change in trading volume. We can calculate the respective change in volume in currency two, and then we can just plot them out, right? So the only unknown here is really whether the volume is a buy and a sell or a sell. So we're just going to do like very simple simulation here. We're going to use the good old tick rule from microstructure, and we're just going to say, if the price goes up following this volume, it's most likely was a buy, and if it goes down, it's most likely was a sell. And it's very dirty and very crude. We can make it a lot more sophisticated, but for the purposes of what we're doing today, we're not going to. Okay. So there also, as in traditional markets, there are now two types of liquidity pools on most platforms. There's public, which is called lit, and private, which is called dark. There's a lot of arbitrage that goes on between the two platforms, between the lit and the dark. So basically, it doesn't really matter if you're on the lit or the dark, because it's all going to be arbitraged away anyway, right? On sufficiently liquid platforms, there should be no difference between lit and dark AMM. Okay, so let's now look at some empirical examples. So here, just using what the process we described, we're going to parameterize Bitfinex data. This is an exchange. This is Bitcoin versus US dollar, 1 hour data for 2022. As you can see, it produces a very, very, very clear curve. Okay, so this is the entire data for Bitcoin. Again, 1 hour Bitcoin price is just done the way I just described it, right? So we look at the changes in prices, and we just plot it out. Okay, very straightforward. So the same we can do for Bitstamp. All right, so here's a Bitstamp exchange. Again, we're using Bitcoin, US dollar. And we're just plotting it out. So it has a slightly different shape than Bitfinex, but it's it's still the shape that we expect, right? So it's pretty straightforward. And now here is our FTX, right? So everybody, of course, heard about FTX. It was a big deal that blew up in September. So if we look at their curve and we plot their Bitcoin exchange rate, and in this case, we're doing 2018 to 2023, it resembles nothing what we would expect, right? In fact, it's for every single dollar that the quantity in one instrument increased in in the liquidity pool, they would actually increase the liquidity in the other pool. So, but when there was a run, let's say there was a run on their model, right? So instead, the price, instead of going exponential, it wasn't. So it's a and you can see they have different curves over the years, and these curves have moved right in space. So they clearly they've been changing the assumptions or some mathematical modeling between them inside, and they seem like they may be even some curves. If you look at sort of the middle right portion of the chart, you see that there's something that's maybe resembling the curves as we would like to see them, but the majority of curves are pointed like completely different way. So, and then let's just continue with Bitstamp, right? So we look at the same for Bitstamp. Again, it's a straight line. So what about other instruments, right? So so here's let's say Ethereum that was also traded on FTX. This is again 1 hour data for 2021, 2022. It's a completely wildly different from any kind of automated market making that we ever theoretically expected. I mean, it's just pointing the wrong way. And the same for the following year, which is getting even worse, right? It's completely wrong. So in this case, we're likely seeing is that it was a Ponzi all along, right? So for the quantity, instead of for the quantity to decrease and asymptotically kind of fade away and making sure the price increases as the liquidity changed in the pool. They did completely opposite, right? So basically that's the key message here. So again, so this just to compare it. So Ethereum, we have other exchanges that traded Ethereum at the same time. As you can see, they is CEX, for example, on the left, they had the curve that we would expect. Oh, but here we come across Binance, right? You may have heard about Binance in the news lately. Well, guess what? They also have this the same curve problem as the FTX has. It's basically pointing the wrong way, right? So that's which defies all the principles of successful automated market making that people have studied in any way. All right. So of course we do have other. Yes.
Can I ask you a quick question about these curves? So all the normal ones go through 0, 0, and all the the strange ones sort of. I guess what I'm curious is like, what are the axes the same or are they a bit different? So here we have Q1 versus cost, and before you had Q1 versus Q2. So could you clarify a little bit?
Yeah. So these are all Q1. Sorry, this should be Q1 versus Q2. It should not be cost. Sorry about that.
Okay. So those are convex curves.
Yes.
Okay.
Right. So they should be convex. Sorry, that's my fault. But they all should look like this.
So we're zooming in very close to the part that's almost like a 45-degree angle.
Right. So some of these, so some of them maybe straight, right? It's maybe almost a straight line. Mm-hmm. So there's a question, and I'm going exactly to that subject. But this is basically our optimal curve, because it makes sure that, like, if we go to sleep, this curve takes care of itself, right? So we're not going to completely lose the shirt, because the price is going to increase exponentially if somebody decides to come and buy all our inventory out. Yeah. Right. So now in this case, what we're doing here is something very different, because it's not working like that. If somebody comes to buy out all our stuff, we just have an infinite supply waiting for that person, and it's kind of defeats the purpose, right? So this is in one of the key things I want to emphasize. All right, so this is it's a great question. So this is our we have our AMMs, right? So, but we have other types of users in the system. So we have traders and we have liquidity providers. So traders are the ones who come and they're price takers, right? So they see what the curve is. The liquidity providers are the ones who are actually supplying the liquidity. So they're funding this pool, right? And they're kind of behind the scenes, and they receive a transaction fee. Okay, so they're benefiting from this whole exercise by getting, in case of Polygon, in many cases, the liquidity providers get 2% on everything, right? Which 2% of every transaction. So that's kind of the economics, how it all works out. And so just you can code it in Python. This thing. So there's a lot of stuff that's coded in Solidity and all these other languages that are kind of derived from C. They're not necessarily graded the implementation, but that's basically the reality we live in. Now, what I want to talk about now is the spillovers in traditional markets. So there are rumors that a lot of firms have been already deploying these automated market making systems in traditional markets. Now, the reason why the rumors is because, nobody came forcefully and said, yes, that's what I'm doing. But the question is, what does it imply for futures and equities, etc.? So let's try to fit this constant product market making in, let's say, IBM stock, and see how it's going to work out. And what we see here, and this is like in 2000, this is sort of a year over year. thing. So we have 2000, and then we have 2010, right? We're trying to fit. So there's not much to see here really. But once we get to 2019 and 2020, we already see patterns that are actually resembling our automated market making curves, right? We have these curves that are asymptotically approaching both axes on either side. And really we can argue that there is a convergence happening. This is daily IBM data. We're doing exactly the same process, that there's convergence happening in microstructure towards this automated market making world. Okay, so that's basically what I'm going to kind of leave you with, is that there is a there are a lot of development. The microstructure is changing in the markets because a lot of the automated market makers in traditional markets are already deploying these systems. And that's basically, I think, the new brave new world. So there are a lot of changes that we can expect with how we interact with the markets, and what kind of output we can expect, and how we build our trading strategies, and how we build our execution, and how transparent everything becomes. Right. So thank you so much. I'm very happy to take questions. Hope this was of value. And again, thank you so much for inviting me. I'm exactly 45 minutes.
Thank you, Irene. So I'm curious again, on these on this last graph, are the X and Y axes prices or quantities, or are they
quantities? Yeah.
Quantities.
So the quantities and the price comes out to be the tangent to this line.
So quantities of IBM stock sold or bought during the course of a day, or
yes. So each data point is it's IBM stock, quantity of IBM stock versus quantity of US dollar in our case, right? Because you can think about US dollar as the base currency and IBM as this token, right? That we're trading. So in this case, we're plotting the quantity of IBM versus the quantity of the US dollar. Okay, and we're moving along this curve, and we're assuming that there's some constant invariant behind the scenes, right? So this invariant is unobserved. We're estimating it, or we can, assume that it's any kind of invariant, but that it stays constant throughout the year, which of course doesn't have to be the case, because we have in real markets, we have shifting liquidity, right? And different market participants can change liquidity. But if we assume that it stays approximately constant, we can estimate these curves. So we can estimate, let's assume that there is an automated market making agent, then we can see how this automated market making agent is pricing, right? And we can actually reverse engineer from this what the liquidity of this automated market making agent is, because we can compute the invariant from this data, right? And of course, this is a kind of this was done. This IBM example is done on daily data, which is very crude. If you go to microstructure data, it's a lot easier to really estimate these things, because we have a lot more granular data there. So, but this is and there is evidence that, like, companies like Jump Trading, they're very much into this automated market making, and there's a lot of research that's deployed in the space as well.
So your curves that were extremely straight, or where the relationship was extremely strong, those were intraday changes in quantity.
Yeah, so what we see with intraday is it's a lot cleaner estimation, for sure. And again, and it's really because we in all of these examples, this is daily curve on the left, though. Okay, so this is an exchange XMO. Now it's a very thin exchange. It doesn't have a lot of liquidity, so there's not a lot of noise, right? So every day we have like pretty clean idea, because we have few trades, right? So the volume is easy to estimate with the basic tick rule, whether it's a buy or sell volume. So and when we go to more granular data, it's easier to see, it's easier to really get this clean AMM curve. When we go to daily data, there's more noise because there's more uncertainty and all of this other stuff, but it doesn't mean that it precludes us from really doing a rough estimate and fitting the curve into it, right? So it's a we can definitely do that even with all the noise that's present. Like in IBM is still very much traded traditionally with a lot of limit order participants, right? So but we can still see the effect of this automated liquidity in the markets. And as markets move towards more 24/7 or at least 24/5 framework, like futures trade 24 hours a day, right? So we can you know, it's really feasible to do this with automated market making. And it of course it gets rid of a lot of risks, such as you know, inventory risk or traditional stuff, asymmetric information, risk of being run over. It's all of that is these systems take care of that. So if you program them correctly, if your curve points a different way, you know, it's a lot harder to to actually do something.
So do you have any tips on, so to reproduce these automated market making curves, where would you go to find that data? Would that be on Uniswap or something?
I think so. I mean, there are distributors. I periodically have people just asking me to take their data, so because they just want to give it away. So there's lots of there. I think that it's truly widely available. So it's not a secret. Now you have to be careful though, because some of the crypto exchanges are still using limit order books. Right. So it's not everybody is and they're doing their own market making limit order books based. So not everybody is deploying the automated market making. But as I showed you in the beginning, automated market making seems to be taking over because it's obviously easier. It's more cost efficient. And it's pretty straightforward. So we'll see there's a lot of research that we need to do if anybody's looking for problems. I think there's plenty of open problems here in terms of risk management and you know, different externalities that people have not thought about. And of course, fraud is a big one. How does it impact the whole ecosystem? But we're just at the beginning of the process to really understanding of how this all works. But I think it's fascinating, and I truly believe it's here to stay. I mean, it's already been here for like since basically 2002 at least. So and I think that's when Hansen's paper was published in 2002, which was the original logarithmic market scoring rule, and I think the platforms have already been adopting it since then. So it's been 20 years of this automated market making. So it's definitely, and it's only growing. It's not going away.
Oh, so the idea was pre-crypto even. It was something that already.
Well, Satoshi Nakamoto was 98, right? So and so I think it's coincided with crypto. I think Hansen really developed his market scoring rules for crypto. I don't think he developed them independently. So it's you know, there was this new thing that was running 24/7, and people somehow had to make markets in that. So I think that was the impetus for the whole score, for the whole AMM. Really, because it was, aside from crypto, there wasn't much need at the time. I mean, even now, I mean, equity markets still largely trade from 9:30 to 4. Of course, there's pre-market trading and post-market trading, so it's not really fair to say that anything trades 9 to 4 anymore. But you know, this kind of their markets officially open at 9:30 and they officially close at 4 p.m. But crypto stays open throughout. So I think people have been looking for this solution since crypto came on board, since Bitcoin basically materialized. And that's I think Hansen's been addressing that in his original paper. But there are lots of iterations of these models since, and it's I think the only constancy is that you want to have this convex curve, because that ensures that you inventory, like you hedge yourself against the the inventory risks and the risk of asymmetric information that you would have in normal market making environment.
Mm-hmm. So I have a couple questions from
Sure.
the Q&A. So the first one from Mika Bong is, I wanted to ask if AMM dealers will have an unfair advantage over other players in the market by having access to otherwise private information, such
Sure.
as order flow. So essentially,
Absolutely.
do AMM dealers or people who, I guess, stake coins
Yeah.
in AMMs, do they see order flow before others, or
They do. They do. Okay. So they definitely do, and it's definitely a problem. But you know what? It's like anywhere you have so many platforms that you can, if you, I think as long as you can quantify this automated market making curve, you can actually shop around, right? So you can shop around and see what platform is the most stable. I think we're now looking into different risk management in terms of what kind of service you're getting, what kind of curve is optimal for your investment style, right? But yes, it is a problem that the dealers do see the inventory before they commit the blocks into the system. And in many cases, that's what motivates those miners to keep going, because, and these are the only miners that are left and often in the system, because for everybody else who does not get any value from mining or like looking into the blocks and validating them, there's just no value for them to stay on the platform and do their work, right? So there is definitely a challenge, and in many cases it can be turned towards a good challenge, right? So we can have a system design, for example, insurance agents, right? So if we have a blockchain for insurance, then it will be potentially in insurers' own interest to validate every single block that goes onto the blockchain, because then they will be able to assess whether this is a block that fits their business model or not, right? So with things like that, there's an inherent incentive for the validator to do their work for almost free. I think that's a big plus. For everybody else, it's like, it's not clear. So there are people that build these huge mining facilities, and they try to make these economies of scale work. But I think unless you have some private incentive from the information that you obtain, it's becoming increasingly difficult to make money in that space. And that's why we see kind of I wouldn't say collusion, but we are seeing formation of these kind of oligopolies. Like if you try to go to Solana today and say, hey, I want to be a miner, I mean, it's going to be very difficult. Okay, because first you have to put a stake, then you have to prove that you have a very advanced system that is compatible with their network requirements and their processing requirements and all these other things. It's just it's computation. There's a barrier to entry now, right? Which did not exist, let's say 20 years ago, right? 20 years ago, everybody could go and they could become a miner and they would collect pennies, and that's what people were doing, like in China, right? They would set up these massive farms that Chinese government has banned since, but because the electricity there was relatively cheap relative to the US, they kept mining crypto, right? So, but not only the China government has banned it, but there are other issues in place that business is kind of, it's basically it's became much more centralized now. People don't do that anymore because nobody can just walk off from the street and to a decent blockchain and say, hey, I'm going to mine it for you here. So that does not work. But there are other applications of blockchain where they could be natural incentives for the miners to really do their work and benefit from it, and not at the expense of traders, right? So they could be like a win-win design, really, but we're talking about now kind of economic system design that would actually benefit from that. And I think insurance is a prime example. The problem with insurance, of course, is insurance sees blockchain as a major threat to its existence, because once you have blockchain and insurance, you don't really need insurers anymore. So that's really we're looking at kind of displacing entire industries at that point. So that's also, there's a lot of resistance to that.
So Irene, I think we have one final
Sure.
question in the Q&A, and then we can call it a day. So James Wonk asks, is it possible there's some kind of fraud scheme even in the IBM curve? For example, you can argue that the bottom right set of points, I guess the graph we're looking at right now, looks like the Ponzi scheme you pointed out earlier in FTX.
Yeah, I think everything is possible.
Is that what we're saying here, or is it more more subtle, maybe?
Well, I think everything is possible. The thing is, here we're looking at the centralized limit order book, right? Where some market participants are rumored to deploy these automated market making models. Okay, so you have some people who are placing limit orders in a traditional way, right? And there are other traders, other liquidity providers, other limit order traders who are placing orders using their own AMM, using their own automated market making system. Okay, so and what they benefit from that, it's very low cost, you know, it's completely automated, and if they make money on it, that's great, right? So it's a win for them. They provide liquidity for the market, and frankly, from the exchange perspective, from a traditional exchange perspective, like if you go today and you build your AMM and you connect to interactive brokers and you place limit orders accordingly, provided that you have these ability to make markets in the market, you're registered as a market maker, I suppose, nobody will be able to tell whether you're placing orders automatically or you're placing orders, you know, if you're using an automated market making algorithm or if you're just placing limit orders, right? Because it's right now, there's no, as far as I know, exchanges do not differentiate the two, and they don't really, you know, they can't. So maybe eventually, I think we're going here, maybe eventually it will be possible to separate in this data, and maybe it is possible now, but to separate, to identify a Madoff. Maybe there is a Madoff that's trading IBM and his curve is pointing completely the wrong way. So maybe we can find the Ponzi players like this just from looking at the data, you know. So and this is another interesting open problem that you know, is it possible to really see that there is a bad actor in the midst just by looking at this microstructure data. So that is something. But the challenge, of course, here is that this is an aggregation of a bunch of liquidity providers, right? Versus the AMMs of individual exchanges, there's only one liquidity pool. So it's a lot more deterministic with every individual crypto exchange as opposed to these centralized limit order books that aggregate a lot of different liquidity providers. And that's where it comes. But I think eventually, if we see these AMMs dominating the markets and continue to dominate the markets, then we will have some sort of aggregation of these curves, and we will see more or less rather divergence in these points, and it's all going to kind of move towards a more streamlined model. But again, this is a bunch of open problems as to where this can all go.
Okay, well, Irene, thanks again for this great talk on AMMs and these new market microstructures that seem to be blending in interesting.
Fun, right?
Yeah. So anyways, thanks again, and I look forward to seeing you in the fall at CFEM.
Great.
And
thank you.
Have a good evening, everybody. Bye.
Thanks so much.